All right, so I sent you the tutorial letter. That's the last year one. So it has more questions, and I think if you guys can have those tutorials, it will work much better, because those ones that are sending online and what they're not full. They say wait for the solution after 2 weeks, and you want to do something and complete. So I get them, but I don't get them as well. So I'll send you those tutorials that I have from last year. I think they are more informative and helpful. All right, because they are actually integrated, so that will actually assist you. More. Right. So there's the tutorial letter. I said we're doing question 2. All right. So remember, in the exam or in class, you are working with your required first. Know what is required of you. So they are saying disclose the land and the building of the manufacturing plant in the PPE, right? Not, it's a not, people, right, to the annual financial statements of Beauty Vision Limited, right, for 31 December 2020, right, for 8 marks, right? Prepare the relevant journal entry in the accounting records of Beauty. Correctly account for the deferred tax consequence of the revaluation. So the second one is a journal. Number 3, they're saying prepare the profit before tax. It's a not. They didn't say they didn't say statement of profit and loss. No, it's a not. Right? They say again, so it's 15 marks. It's got the most marks. Then disclose this deferred tax balance, excluding the manufacturing machine, right, in the nots. Right, so it's a deferred tax not. All right. And then everything was 40 marks. So it's an integrated question. Right, so before I do anything, let me draw the required frameworks. All right. All right, so these are the structures required. So if you are clever as well in the exam, go to the required, and then immediately as you are reading, have a rough sketch of the required. If it's a note, the note, just like that. So that when you're starting to write, you're just filling in, you're faster. And to draw as you are, so it's becomes problematic. Okay. So for the first one, they wanted the PPE note. So we are dealing with PPE notes. This should be a bit fresh, right? We're dealing with 2 assets, buildings, right? So you know this is the note. So whenever they say PPE note, they're talking about the structure. So you are going to have your carrying amount, right? So we're dealing with 2020. So that means this will be Jan 2020, right? Then you've got the costs. Then you've got the accumulated dip, right? And then from there, you are going to have your, if there is any revaluation, right, on land, right? Then if you are going to have depreciation for the year, then if you are going to have any additions, at cost. So when I said cost, I'm saying you included at cost. All right. Then from there, you are going to then have your carrying amount at the end. So let's get our calculators ready so that we move a bit fast before we tire. Because I know we're coming from work. Want to finish and go and rest. It's cold as well. Accumulated dip. Then here I'll come and write paragraph 7.7. All right. The statement that you write here. Okay. Because I'm introducing to CTA stuff. So that when you come next year, that's if you're going to be with us. If you don't go to Melpark or you don't go to IAS, you'll find us here, God willing. Right, so we've got that. We need to deal with that information. So now let's address as we go. So Beauty Vision is a manufacturer and retailer of beauty products within the cosmetic industry. The company has a 31 December year end. So always take note to remember the year end. Indicate what is the year end. Otherwise, you get lost. You won't know where to start when you're depreciating, where to end. Okay. Details of the company's assets are as follows. Manufacturing plant. On 1 March 2017, remember we're in 2020, so this was decades ago, right? Beauty Vision purchased a vacant land for 2.5 with the intention to construct a manufacturing plant on the land. The construction of the building that will house the industrial machinery of the plant commenced on 1 May 2017 and was completed on 31 Jan 2018 at a total cost of 4.4, excluding inspection costs below, which was paid in cash. Management considers the land portion of the manufacturing plant to be significant. Right. In order to comply, if the city I was going to explain, but I'll leave this significant now. Right. In order to comply with the national safety regulations, the building was inspected at a cost of 50,000 on 31 January 2018. The safety inspector issued a satisfactory report and confirmed that the building adhered to all necessary safety regulations. The construction workers went on strike during the construction of the building. Yeah. Right. The construction workers did not report for duty for a period of 2 weeks. Yeah. Included in the total, so these are the words that make the difference. Included in the total construction cost of which one? Of 4.4, right? Of the building referred to above are salaries amounting to 80,000 with regard to labor costs paid to the striking construction workers during the 2 weeks strike period. The building was available for use when, right, as intended by management on 1 Feb 2018, whilst it was only brought into use on 1 March 2018. Right, on 1 Feb 2018, a residual value of 2.3 was allocated to the building, and the residual value was estimated to be 30 years. Residual value is sitting there. Right, both residual value and the estimated useful life remained unchanged throughout the period. Yay. Right, it is the accounting policy of Beauty Vision Limited to account for land using the revaluation model. It's allowed. Revaluation will be made with sufficient regularity to ensure that the carrying amount do not differ materially from that which will be determined using the fair value at the end of the reporting period. It is the policy of the company to realize the revaluation surplus through the sale of the underlying asset. The fair value of land on respective dates as determined by an independent sworn appraiser were as follows. It is the accounting policy of Beauty to account for the building in accordance with the cost price. Depreciation is accounted for in accordance with the straight line method over the estimated useful life of the building. Voila, done. So this was a PPE question. All right. So how to approach this? You approach this by getting the easy marks first. Land is the easiest. Okay. Land is the easiest. Right. So remember, in accounting, we move with the times. Okay. So that's why your timeline is very, very important. Okay. Here, this was 2019. All right. 2019, the value of the land was 2.580. 2019. We are in 2020. 2020 year end. This building has gone to what? To 2630. Right. So these are the free marks that you'll get. Right. So even though they say the land was what? It was 1 May 2000 and what? And 17. And we bought it for 2.5. Yes, back then. But remember, land does not stay the same. That is why we rush when someone says, yo, there's land on sale. You're like, yo, in 10 years' time, this value of land had gone up. What is that? Your accountants. That's a revaluation. That's why you buy land and keep it. Just imagine if you had a piece or your family owned a piece of land in Zantin back then. Does it make sense?
Mm-hmm.
So land will never stay the same. Land will always rise in value. That's why people keep land. So that it grows in value. Because it's either there will be a working something that will be happening, whether there's a mine next door, or it will always increase in value. Of course, there are other things that will decrease the value of land. If maybe there's chemicals discovered, or what things that kill the environment, now that can then depreciate. What you call this, decrease the value, right? But otherwise, when it comes to land grows in value. So we are told that this was then when we bought this was the value. And then 2019, right? Remember, our current year is 2020. So in 2019, the value of land was how much? It was 258, right? And then in 2020, the land was how much? Was 263. So it's growing. So this value will become the opening. This was the last year, previous year value, right? So it will become the opening. Easy marks. So you don't use this figure anymore because the value of land has changed. All right. This one, we use it later. I'll show you where to use it for tax purposes. But accounting, we move with the new value. So when we're opening the current year, the cost is that much and the carrying amount will be the same. Because land does not depreciate. Don't forget that. Non-depreciating asset. All right, so there won't be any depreciation here. Hope that makes sense. Then in the current year, if in order for you to record something here, you come and record this value at the end of the year, right? There's a new value of that much. That means the carrying amount will be the same. All right, no depreciation. So how do I record the revaluation? You just look at the balance at the beginning minus the balance at the end. How much do you get? That manage that?
50,000.
50,000. Then you come and record your revaluation there. So in other words, you are saying this new opening balance plus the revaluation should give you that figure. You're done. No depreciation on land. There were no additions. So you leave it like that. Okay. Then you get your nice marks without struggling. Then now when you come to the building, right? That's where you might get a challenge if you don't understand your depreciation. But let's see what we can do. Building. Right. So with this one, we didn't buy a building or we didn't have a building. We're constructing. So you know that from your accounting, right, those construction costs, you add them together. All right. Add them together. So we have a cost. I'll just say given. Right, of how much? Of 4.4. All right. And then we are told that there was somewhat a labor costs of how much? Of 80,000. So what is happening here? Remember, what is the principle behind determining the cost of an asset, right? We are saying that this is the cost that was incurred that is directly related to the what? To the asset, to make the asset available, right, as intended by management. But now we are having employees that were not working during the construction time. So that means that cost that was paid to those guys while they were on strike, right, cannot be linked to the construction, because we just paid them because they were on strike. So they were not working for those 2 weeks. So those 2 weeks, right, of no labor cannot form part of the cost of the asset, because there is no link. There is no link between them working and that cost being incurred for the building. Does it make sense?
Mm-hmm.
So read the question carefully, right, on Monday if there's something like that. So you need to subtract it. They told you that this cost is included in this 4.4. So you remove it because it is not directly attributable to the construction for those 2 weeks. They were not working in the building. They were sitting at home, right, shouting and protesting. So that cost cannot form part of the construction of the building. So you remove it. And then now, any inspection costs, remember, we are saying all costs that were incurred to make the asset ready and in a condition as intended by management. So in order for us to start using that building, we had to pay someone to inspect. So the inspection costs are directly linked, because without this thing being linked, we're not going to open the building. So in total, our cost is how much? I'm getting 437,000. Please confirm.
Correct.
So this building was ready for use when?
1 March.
1st of Feb 2018.
2018, we're in 2020. So that means from the date that it is available for use, that's when we start depreciating. So brought into use is for tax dates, because SARS won't allow you to what? To claim the allowance before you start what? Bringing that thing to use. But in accounting, as long as it is ready and available, right? It is there by the sideline. It's like a sub, right? Who's ready, right? Warming up, even if you don't play. Just because we are there, we are happy. Né? So that is accounting. All right. So now you know that, okay, when it comes to this, we need to calculate depreciation. So our depreciation right, will be based on these costs, right? So you'll come and say, therefore, my dip will be equal to the cost of how much? Of 437,000 minus residual value. Residual value we're given as what? 2.3 million over the estimated useful life of how much?
30 years.
Multiplied by. So here we want the accumulated, right? From the time we bought this company, this was ready for use until the beginning of the year. So we're saying it was ready for use as from which date? 1 Jan.
Feb. 1st of Feb.
It was Feb 2018. So we want that until 31 December 2019. How many months is that? Calculate.
It's 11 months, but it should be 2018 also, Jeff.
Yeah, no, I'm saying count months from this date until then.
To then. Oh, okay.
From here to here. I know that here there is December 2018.
It's 23 months.
11 plus 12. 23.
Okay, giving you how much? 23. So you'll come and say that's a shortcut. So how much do you get? So what we're saying is, so far, how many months have we used this building for? From the time it has been available for use until the end of last year. It's 23 months. I'm getting 132, 250. So that becomes your accumulated. All right. Your cost is that one that you just got there. Then that minus that, give you a carrying amount. How much do you get? I am getting 4, 2.
7.
All right, so that's what you get. So do not forget that you need to accumulate. Accumulated is from the time it was available for us until the end of last year. Why am I saying last year? Because whatever balance was for last year closing becomes the opening. That is the secret. Right. Then you reference your work, whether this one was calculation 1. You can come and say calculation 1, examiner. Then this is calculation 2. It's up to you. But if you don't reference, then you don't get your marks. You're copying. Then depreciation for the year. Right? So in the current year, we use this thing for the full what? 12 months.
12
né?
months.
So we're depreciating this time over 12. Let me just delete this one. There won't be any changes. Just it will be 12 over 12, right? So that minus that divided by 30 years, how much you get?
69,000.
That's your depreciation. And remember to put brackets, otherwise you are adding, right? No additional costs. You don't revaluate your building here. So the cost at the end will be the same. Then accumulated will be this plus that. Because this was the opening balance, this is what we incurred in the year. So this plus that is how much? Okay, I'm getting 201, 250. What minus 4370, which is how much?
$201. How did you get 201?
132 plus 69. I mean, we're accumulating the depreciation.
Yes, okay.
Okay,
Mm.
right. So that's what you get. Any questions? Okay, then let me take you to PPE a bit. to the standard. Change it to PPE, the standard. All right. We'll go to 77. So you see disclosure, what to disclose under PPE. This is the standard for IS 16. Right. So if you go to 77, the one that I wrote there, they tell you, right? They say if item of PPE are stated at revalued amount, the following shall be disclosed in addition to the disclosures required by what? IFRS 13. The effective date of revaluation. Whether an independent sworn appraiser, an independent valuator was what? Was involved. Okay? Right. Does it make sense? You're just stating, they're telling you what to tell the shareholders. When was the revaluation done? All right. Whether an independent valuator was involved. You understand?
Okay.
Is that difficult?
No.
Let's try and find out, right? When was this revaluation done? This one. There is the date. Right? Who did it? Can you respond? Do you understand?
Yes.
So that's what you write under that PPE note. Don't forget, it's a free mark. You just say revaluation was performed on 31 December 2020 by an independent sworn appraiser. That's it. You get 1 or 2 marks for that. Right. If you understand, can I move on?
Yes.
Then we come to this one. Prepare the relevant journal entry in the accounting records of beauty to correctly account for deferred tax, our friend, deferred tax consequences of the revaluation of land of the manufacturing plant on 31 December 2020. All right. So here we need to account for the revaluation of land of the manufacturing plant, right? So they're talking about this revaluation from 258 to 2630. That's 50,000. Right. So here we go to, let's go to paragraph 39. I'm just throwing in a bit of the hard bone. All right. Can someone read here? Someone read for me paragraph 39. If an asset
Carrying amount is increased as a result of a revaluation.
If an asset carrying
Yes, go on. I think Rip started.
assets carrying
Oh, Lucy, continue.
amount
If an asset carrying
if an asset carrying amount is increased,
Okay, we need feedback. Okay, let me read then. If an asset's carrying amount is increased as a result of a revaluation. So we are saying the carrying amount, right? What are we talking about? So the carrying amount, right? Remember, beginning of the year, it was 2,580, right? So it has been increased due to revaluation. The increase shall be what? Recognized in what?
Another comprehensive income.
Okay. And they are accumulated in equity under the revaluation surplus. So they are simply saying that gain, right, that your land has what? Has made, you record it in other comprehensive income. Okay?
50,000.
Yes. So I'm supposed to record it under what? Other comprehensive income. You understand? On the credit side. And also increase the land. So you come and increase that revaluation surplus and also increase the land. That would be the general. Okay? Okay, I'm just saying that would be the normal general. But now remember, this thing it takes effect. Right, so this will have a tax effect. All right, so normally the journal is like this. Yeah, the journal is like this. So we'll come and say a journal 1. So the date is 31 December 2020. Right. Here I'm just giving the full journal, but then I'll show you the tax consequences. Right. So the land went up. All right. By how much? 50,000. Then they're telling us, that's what the standard saying, any revaluation, any increase, not decrease, any increase is recorded in what? So you come and say revaluation surplus. Just giving you the extra information. Okay. So this is based on paragraph. You're learning paragraph 39 of IS 16. Of IS 16, right? Right. So what about the tax effect now? So remember, when you increase the value of land, SARS will get you, or SARS will catch up with you when you subsequently sell the land. Okay. Are we together there? So once you sell the land, SARS will be able to tax those gains. Now they can't touch you because they're just gaining them, but you have not sold. Once you sell, because remember, you are going to sell with the latest price. So that price will include all the gains that you had in the previous year. All right. So then when you now sell that, SARS says there is capital gains. All right. Because you are selling above the cost. Remember, this land was 2.5. But by the end of the year now, it's sitting on what? It's sitting on 2,630. So its value is gone now. So they cannot touch you because you're not sold. Once you have sold, they are going to tax you on the latest value. And that value will be a value of the cost plus all those gains that you're gaining over the years. That's why they're saying through sale. So there is capital tax. So you record it now, that taxation side. So what will happen is this will then reduce the revaluation. Let me write it. Okay. So the journal that they wanted was the tax side. So by you taxing this, you need to reduce the revaluation. Revaluation surplus. Okay. And recognize deferred tax. What? deferred tax liability, SFP. Right. So remember the calculation would be that 50,000 multiplied by 80%, then 28%. Remember, SARS does not tax the full amount. You will only tax 80% of 50,000. Then that will be subject to the tax rate. So how much you get?
$11.
All right. So that is accounting. So people always struggle, but what you are saying is this is the original cost. Right. So it has gained something here. Remember, it gained how much? Okay. Remember, it gained 80 because it what? It gained 80 here because the value was what? Was 258. So this has since gained this. So SARS won't tax it now, right? And then later on, it gained another 50. That's why in overall, you now have your land sitting on what? So now SARS cannot touch these because you're not sold. But once you sell, just in case you decide to sell now, you're obviously going to sell at the what? Fair value. So they'll be able to then tax these gains. Remember, SARS does not tax the cost. He only taxes you above what you sold, above the cost price. So this will be above the cost price. This plus this is what is taxing effectively. I don't know if you get my story. All right, let's go. All right, let's go to the profit before tax note. So the profit before tax note is a note, right, where you inform the shareholders what makes up that figure of what? Of profit before tax. What special things that need your attention, right, or the attention of these guys is included in that profit before tax note. All right, so whatever information they give you that affects your profit before tax, profit before tax is what you're going to highlight there. So you'll come here and say what? Income. Right, you say income, then you leave it open. Right, you leave it open. Then you come here and say expenses. Right. So with this one, there is no brackets. You are just stating and writing. All right. You don't have to say what? You don't have to say open brackets, subtraction. No, you just write the figures as they are. All right. So this note, let's try and answer it. Okay. So the first thing that you should think of when you are doing this profit before tax, you are thinking of any incomes and expenses that took place in the current year. Right. That's your way of approaching this one. Any expenses, right, that affect the profit before tax and any incomes. Right. So the first obvious one, if you're thinking like me, is this one. Okay, that should be your first entry there. So you'll come here and say what? Depreciation. Depreciation, then you come and say building. All right, then you reference. What was that? That was what? That you just come and say required A. Then you come and write 69. Don't have to put brackets. You're just indicating that the profit before tax note includes depreciation from manufacturing plant of 69. Are we together?
Yes.
Right. And then let's go and look for any incomes and expenses. So here we don't have anything else. So we leave this. We're done there. All right, let me come and do this one with you. Right, let's keep the investment property. I'm going to end with it. Okay, let's go to what we know, manufacturing machine. Right, on 1 October 2020, Beauty Vision purchased a new manufacturing machine at a cost of 1.680, right? And immediately paid a cash deposit of what? Of 580, right? So this thing is costing you 1.6, but you have only managed to what? Pay how much? 580. Beauty negotiated special payment terms, RIPS, with the seller and deferred payment of the remainder of the purchase price of the machine until 1 December 2020. The seller's normal credit terms are strictly 30 days after purchase date. The manufacturing machine was transported to the manufacturing plant at a cost of 15,000 and was installed and tested at an additional cost of 12,000. The manufacturing machine was available for use as data management as well as brought into use on 1 November 2020. On 1 November 2020, an estimated useful life of 2 million units and residual value of 750,000 was allocated to the manufacturing machine. From acquisition date until 31 December 2020, the manufacturing machine produced a total of 96,000 units. Machine is accounted for with the cost model. Depreciation is written off according to the accordance with the units of production method. So how do you approach this? There's 1 October when you bought something, then you paid a bit of the amount, maybe because of cash flow problems. And then the balance you are saying you're going to pay on 1 December, which is 2 months later. So now you need to be careful. Look at the normal credit terms of the company. That is the principle. What is the normal credit terms of the company? If it was 60 days, then this was going to be within the normal. But this guy is saying strictly 30 days. So that means for this person to give you 2 months, you are outside the normal. Therefore, there's what they call deferred payment. Right. Let's go to, I showed you this one. It's paragraph 23. I'm loading you the information. Don't worry. Right. Let's go. It says the cost of an item, so measurement of cost. The cost of an item of PPE is the cash price equivalent at acquisition date. If the payment is deferred beyond normal credit terms, the difference, so it's minus, the difference between the cash price equivalent and the total payment is recognized as interest over the credit, this one. All right, such interest is capitalized in accordance with this one, okay? For now, don't capitalize it, okay? So that is what they're telling you. Sometimes people don't have enough money. So they then want to pay us later. So we need to discount that, use our calculators and determine their value on the date when we bought. Right, so they are saying if it's beyond. Right, so we're saying it's beyond. Right, so we need to then calculate the deferred, call it deferred payment. So it's a lot of marks, this one, okay? Once you understand it, it's easy. You will be smiling all the way. Right, so what are we calculating? We're trying to establish here. Let me use Let me use what page 1. All right. Let me come and say deferred payment. Not here. Okay. Let me first say machine, manufacturing, machine, manufacturing, machine. All right, there we go. And then we'll come and say we deal with the cash. Payment paid is how much? Is that one. And then we've got the special one, special case called deferral. Deferral of payment. You want to pay later. Right, so what is the balance? The total amount was 1,680, so 180 minus what you've actually paid. So our balance is equal to what? 1,100,000. Then use your calculator, whether it's the sharp or the HP. You come and so this amount is a future value because you're going to pay it later. It's a future value because you're going to pay it later. So it's in the future. So in the future, I'm going to pay you this much. Oh, okay. At what rate? And the period. And then you look for the PV. So the rate they will always give you. Okay. The rate they will give you. Right, there is the rate. Right, it's always the pre-tax, not post, always pre, not post, always pre-tax. Right, compounded annually. So this is the rate per compounded annually. All right, so you use that to discount, to go back. Use this rate to go back. All right, to October, because that 1.1 will be paid in December. It's a future. What is the value of 1.1 now in 1 October? So we use this rate to discount. Okay, so that is the rate, 8.7 that divided by 12, because we want the rate per month. Okay, and your N is how many, is how long? Remember, you want to go back to 2 October because the payment will be made in 1 December. So going back this way, you go back how many times? 2 months. Is that not true?
Yes.
So you go back 2 months. So you'll come here and say 2 over that multiplied by 12. Right. Then let's look for the PV. Let's all go. Let's clear all. I hope now by now we know how to use our calculator. If you don't know, please inform me. I guide you. Oh, this is 1.1. Yes. So let's go. 1.1 million future value. 8.75 divided by 12 is your interest. All right. And then 2 divided by 12 multiplied by 12 is your N. Compute, I'm using the sharp for the PV. I am getting 108,132. Confirm.
Correct, sir.
Right, so that value will earn you 4 marks. That is the present value because you are dealing with what you can control. So its present value is that much. You come and edit here. Then obviously we've got the what? We've got the transport cost. because without the transport, we couldn't bring the machine to its what? Intended place and location. So we come and add the costs of that. Then we'll come here and say testing costs, because we're to test if this thing is working. So the testing costs as well of 12,000. Then we're going to add everything together. How much do we get? Right, 580 plus 1,084,132 plus 15,000 plus 12,000. I am getting 1,691,132. Yes. Then when you are done, you can then say, oh, okay. Now depreciation. Okay. So remember the formula for depreciation, the cost will be 1,691,132 minus the residual value we were given as what? As that over total expected units. So it's 2 million. Don't be afraid. It's 2 million is given. Multiplied by how many units have we produced so far? 96 million units. Then calculate, you get your depreciation. Let's go that minus 750. I get 941 divided by 2 million. I multiplied by 96. I then get 45,174 is my depreciation for the year. Then I then transfer this to here. I'll say machine. Machine, maybe you say calculation 3, examiner. And you come and write. All right. Any questions? All right. And then we were told, people, we were told by the standard, if you're listening carefully, right, that the difference between the cash equivalent, right, and the total payment. So the total payment is 1.1. And the cash equivalent is that 108. Right? And then the cash equivalent. They're saying the difference between that is recognized as interest over. So it's that minus that. Does it make sense?
Jeff, can you repeat that again, please?
Right, it difference. What I'm saying all the way to is that you want to pay me. You're saying, Geoffrey, I don't have money for fees. So I would pay you how much? I would pay you I'll pay you the fees in 3 months' time. Then I say the normal number of days that I allow for someone to pay is 30 days. So when you discount that 1,000 to today, where we are today on a Tuesday, its value will be obviously less. Then therefore, the difference between the 1,000 that you're going to pay me in 3 months and the present value of that 1,000 is an interest expense.
Oh, okay.
All right. So we need to account for that interest expense. It's a hit. That one is a free mark if you know what to do, but it's also difficult if you were not taught. But that is the explanation. So you'd come here and say, how many depreciations do I have? Yeah. So you then come here and say interest expense. Interest expense is going to be that 1,100,000 minus 18413. That you get your answer. How much?
15,868.
Right. So they'll be marking. This person knows what they're doing. All right. Then you're almost done. Then you're almost done. Then let's do the investment property. Property. I won't do the intangible assets because we're not yet there. So this patent, if you're wondering why I'm skipping, is intangible asset. All right. You can't touch it. It's intangible. The patent is intangible asset, so you can't touch. We're not there. Right. Our focus now is on the residential property. Okay. On 1 Jan 2018, Beauty Vision Limited purchased an old abandoned residential property at a property auction for 1.6,885,000. Land that, building that. On acquisition date, management decided to utilize this property as rental property. However, due to the fact that the property had been vacant and abandoned for a long time, it had extensive damage and required major renovation in order to secure a tenant. The renovation of the property was completed on 30 September 2018.
Hello.
Yes. Right, on that, at a total cost of that much. On 1 November 2018, Beauty Vision Limited signed a lease agreement with a reputable tenant to receive a monthly rental of 25,000. Monthly, 25,000. Direct operating expenses relating to this property amounted to what? 9,500 per month. So these are free marks. All right. So this is how you identify an investment property. It is not owner occupied. It is not what? Owner occupied. Okay. RIPS, you have a house. Okay. You just bought it, but you're not using it. I am staying in that house. So it's your house, but you are not occupying it. Someone else is occupying. That's how you identify an investment property. So it's just for an investment. So such property cannot be classified as PPE. It's now governed by a different standard called IS 40. Okay. It's now governed by what? IS 40. It's your property, but someone else is living in it. We all do that. All right. You've got a holiday home in Durban that you rent out, or in Cape Town, or in Knysna, or in Mpumalanga, or Western Cape, or Eastern Cape, or Northwest. Okay. So those properties are investment properties because they are not owner occupied. All right. So sometimes it's possible that, okay, maybe you love your house. So maybe you are now living maybe in a cottage, but the main house is occupied by by tenants. So that's why you get the, was it this one? All right, so wait a minute. Let me show you where it is in the standard. So I explain as I go. I prepared this last week, so now I need to look for the standard and show you. All right, so now I'm on IS 40. So I'm teaching you as I go. Okay, let's start here from paragraph 5. Right. So they are saying, okay, investment property is property, land or building, or part of building or both held by the owner or by the lessee as a right of use to earn rental for capital appreciation or both, rather than for use in production, right, or administrative purposes. Okay, so they're telling that it is to earn rentals or for capital appreciation. Okay, so if it's classified as that, that means it's an investment property, because students will always ask me, what's the difference between PPE and investment property? That's the difference. PPE is owner owned. So it is owner occupied, not owner owned, owner occupied. So that land is you using it. Those buildings, you are using them. That's PPE, IS 16. IS 40 is your property, but you're not there. Right, then we go to paragraph 10. Okay, some properties comprise a portion that is held to earn rental or for capital appreciation, and the other portion is held for use in production or supply of goods or services or for administration purposes. If these portions could be sold separately, right, and entities account for these portions separately. If the portions could not be sold separately, the property is investment property only if an insignificant portion is held for use of production or for purposes. So you'll get a lot of this word, insignificant portion. All right. So what they're saying to you is that even if in your nice, beautiful house, right, you've got a small cottage there. All right. So this is the yard. So you're using this for admin, because you want to be out, maybe there's a house somewhere. And then this one is for rentals. So because of this, if you cannot sell this separately, okay? If you're gonna sell this separately, right? So you then look at the portion that you're using for your own, because maybe this is your office. You don't want to rent out, but since you have property, you're saying, let me use this cottage as my office. Then this part is rented out. So if once the question says this part is insignificant, this part is what? Is insignificant, according to paragraph 10. Insignificant portion. Right. Therefore, you account for this whole land as what? Investment what?
Property.
Exactly. Even if there's an office there, right? Maybe they say this one makes up 30%. This one makes up 70%. The question will tell you that this other portion is insignificant. So the reason being, they are saying you cannot sell this on its own. And dominating is the investment property. So we consider this whole property investment property. So you don't depreciate this, we ignore it. And treat it as what? Investment property. Are we together?
Mm-hmm.
Yes, sir.
So you get a lot of, especially if you're going through investment property questions, you get them saying that. I think there was a question. Where is this one? I thought we were going to do this one, but I just saw that it is so individualized. So I was like, on its own, it won't do. Right. It's I wanted us to do this, but we won't do it Right. It says, right, investors occupy only 40% of floor space of the office building for their own administrative purposes. The 40% that investors occupy is deemed to an insignificant. So they're taking this from paragraph 10. So everything comes from the standard. Nothing that doesn't come from the standard and cannot be sold separately. You see, I've taught you something. So therefore, the whole building is investment property. So when you see this, don't panic and start trying to divide the figures and say 1.2, 2 million times 40%. No. This should set you free. Whoever hears these words shall be free. Free indeed. All right. So there we go. But I'm not here. I'm here. All right. So there is our property. Although I think here there was a mistake somehow. This date is wrong. This was supposed to be 2020. I think they just copied and pasted this, but they forgot to change. It was supposed to be 2020 here. Right. Okay. So we've read all this. Okay, we've read all this. Yes. So I was saying, by the way, so the rental income is a free mark. So it's monthly 25,000, and the direct operating expense is 9.5 per month. All right. So all that will be free marks for your profit before tax note. So you come here and say rental. Rental times what? 12.
Well,
Free mark. This one you don't have to think. Right. Then you come and say direct operating. Right, which is 9 that times 12. Free mark for you. Whatever you get, you just write. Here you don't balance, you're just entering the figures. It's a note, okay? You're disclosing information. So you're not giving the balances or subtracting anything. You're just telling them the expenses. That's why we're saying profit before tax includes. So we're notifying them that the profit before tax balance that you see includes these transactions. We're making them aware, the shareholders, the owners of the company. Right, so far so good. Okay, and then in your what do you call this? In your investment property, right? Investment property, right? I want you to go and read for yourself, right? Read for yourself, right? Any revaluation that takes place, right? Any revaluation that takes place is recorded where? Right. Let's go to 33. Yeah. Right. Can someone read 35 for me?
A gain or a loss arising from a change in the fair value of investment property shall be recognized in profit or loss for the period in which it arises.
All right. So you get the difference, right? Under IS 16, they said any revaluation of any PPE asset, where you post it, other comprehensive income. Right. When it comes to IS 40 here, as you can see, the standard, they are saying any gain, right, from the change of a fair value shall be recorded in the what? Profit or?
profit and loss.
And loss. You're done. You're done. Right. So what are they talking about? right? That's why I'm saying here there was a mistake. They should have said 2019, 2020. Right. Why? Look at these figures. What has happened to the land? The land in the previous year was how much? 476. Now end of the year is how much?
490.
So there's a what? There's a gain on what?
Increase.
An increase. And remember, this is investment property. You need to separate investment property. So here, and also with the building, right? When we opened the year, the building was 190. Now there's what? It's on 211, right? So when you follow the standard, there's another free mark. You come and so it's called fair value. Fair value adjustment. All right. So you'll come here and say 490 minus 476. All right. Plus, so this one is for the land, that gain. Then for the building, it's 2110 minus what?
1900.
Right. Whatever you get is the gain. So you are following IS 40 paragraph 35. That's how you do CTA, by the way. Ne? Everything is just there. Once you know how to maneuver, answers are before you. If you're cramming, then problem. Right, any questions? Right, so basically you'll be done with this. You get your 15 marks. Imagine this was 15 marks. 15 and a half, as I said. All this. As long as you reference your work, then you'll be happy at the end of the day. Then let's do the last one now, the deferred tax. Right, with the deferred tax, now you're just calculating deferred tax. Remember, deferred tax is you're saying there's a difference, right, between the carrying amount that we recognize in accounting and the carrying amount that SARS uses in its books for the same asset. So that creates a difference. But that difference is temporary. Just a temporary basis, right? When you don't have money, it's temporary. It's not permanent. Okay? So that's why we're also saying that treatment, the difference is on a temporary basis. But eventually, we're going to arrive at the same amount. Okay. So now, when it comes to that, what are they saying? They're saying deferred tax, excluding the manufacturing machine. So excluding the manufacturing machine, and I also want to the patent, intangible asset, because it's not part of what we are covering. So we're leaving out two things. So we're only going to do deferred tax. Deferred tax on what? On the manufacturing plant, which involves the land and the building. And then we're also going to do deferred tax on the investment property, the residential property. So with this one now, we need to know how does SARS treat those things. You need to come here. So this section is very important when it comes to deferred tax. Right? So the rate is 28%, capital gains is 80%. Then SARS allows the following capital allowances. A 5% annual building allowance on manufacturing building, not on everything. Remember, so residential buildings are not manufacturing. So they're not subject to 5%. Okay. But the manufacturing building is subject to what? 5%. Okay. And then blah, 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 blah. There's nothing else that we need. Wanted this right? So we'll come here and say what? We'll come here and say manufacturing plant consists of what? Of the land. Right. So here you are looking at the end amounts. Okay. You're looking at the what? At the end amount. You go to your PPE note. Right. You come and take this figure. So in accounting, our value of the land is how much? Is this one. That is in our books in accounting. So far in 2020, the value of our land is 2630. All right, 2630. Right. What about SARS? SARS is a problem. Right. Remember, SARS is not moved by revaluations. Okay. SARS does not do revaluation. All right. Okay, he sticks to the original amounts. Just like our parents, né? We do things, we like to do things the new way now, right? Do that. Some of our parents are hostile, right? They're used to whatever. So that's how SARS does things. So he sticks to the original amount. Sometimes we call it the historical amount. He maintains that one. Hence, that difference is created. So originally, what was the value of land? Historically, what was the value of the land?
2.5.
It was 2.5. That's how SARS works. Confirm. Right. 2.5. Okay, 2.5. So SARS will benefit from this gain that you have recognized. Remember, in their books, they're saying your land is 2.5. But you are saying your land is now at what? At 2630. So SARS will be able to tax you when you sell this asset. So there will be capital gains. All right. And then the tax rate. So whatever, how much you get there?
$29,120.
29,000.
120.
Right. So you remember the song. The carrying amount of an asset is greater than the what? Tax base. Therefore, we have a what? Carrying amount of an asset is greater than the what? Tax base. Therefore, we've got what? Deferred tax what? liability. And we show this by putting brackets. Okay. So as long as the carrying amount is bigger than the tax base, then you've got your amounts in brackets. Yeah, you forgot, no?
No, we remember, Chief.
I will remember. Then why are we quiet?
Network
right.
is slow.
Hmm? Okay, right. Then you've got your carrying amount for the building. You just go to your note, that amount. Okay, that is your amount, right? 4,168,400. Sorry, 750. Right, that is your carrying amount according to accounting for that building. Okay, that is your carrying amount. $4 million. I forgot. $4,168,000. $250.
750.
750.
Yeah. Right. Minus. How does SARS treat these things? Remember, SARS says, yeah, SARS would go to the cost. How much was a building originally?
4.4.
2.2.
It was that, was it that? Inspection cost, the cost. So if it's going to deal with the, how does that deal with the inspection costs?
It says total cost is 4.4 excluding inspection cost. Of which inspection cost it was.
Remember, originally with that calculation, we need to find out how does SARS also respect these costs? So he does. So if he's going to do that, that means we're using the same cost. Ne? We're using the what?
Oh.
We're using the same cost. Remember, this one was before adjustments for this. So SARS also takes into account what you did there. He honors that and says, okay, that's fine. So this is your cost of your building. All right. So which is your 4,370, right? Then SARS says, okay, on manufacturing buildings, we allow 5% per year. How much do you get?
It's 218,500.
So every year, that's what we allow. Okay. So far, when did you bring that into use? That was 1 March 2018, eh?
Yes.
So that was 1 March 2018. So 2020, right? There is another what? Same amount. They don't change. Then 2020, same amount. That's the allowance. Remember, you are claiming on the cost. So SARS says claim that cost using 5% every year from your taxation. So in total, okay, there's so many ways of doing this. I was just trying to explain what's going on. So this multiplied by 3 is how much?
655,500.
So remember, we want the carrying amount. So you take the original cost, then you less what you've claimed so far. Then you get your tax base. How much you get?
It's 3,714,500.
Yes.
Right. That is your tax base. So we are just saying that SARS calculates, maybe, let's say if I may put it this way, depreciation separate. Oh, sorry, different. So you guys, because of a depreciation, you're on 4. When they're using that, their way of depreciating the building, they are on what? They're on 3 stat. So that means there's a difference in amount. So that creates a deferred tax. So that multiplied by 28%. Right. So you only use 80% on non-depreciating assets. Non-depreciating assets. That's where you include that one. This one is depreciating. That's why there's no 28%. So that minus that multiplied by 28%.
$127, $190.
127,
$190.
190, right? Carrying amount of an asset is bigger than the tax base. Therefore, we have got what? Deferred tax. Right, are we together?
Yes, sir.
Right, then we are done with this one. We then come to the investment property. If you want, you can come and say residential. Residential property, you still have land. Right, on the land, right? In accounting, remember, we are modernized, so we stick to the new value. So our new value is how much? As at 2020, right? That's why I say these guys made a mistake on the date allocation on this. Right, I'm using the latest one. So I'm taking this. And for the building, I also take this. But SARS is old school. Remember from the notes I gave you, right? SARS will go back to the historical amount, right? And use what? 450, the original cost. I repeat, SARS will use the original costs. We go with the times. Next year, if we change again, we use that, the latest one. SARS will still maintain the 450. Are we together?
Yes.
Yes.
So that and that. Right. Land does not depreciate. So the 80% comes back in. 28%. How much do you get?
It's 8,960.
All right. Carrying amount of an asset is greater than the tax base. Therefore, we have a what? Deferred tax liability. Then the building, right? We agreed we are using the latest amount of 2,110,000. Right? SARS is using the old amount. What is the old amount of the building? All right. Plus what? Renovations. What are renovations in taxation? Improvements. Yeah. Hello?
Mm. Yeah.
So at the end of the day, what you originally spent back then, whenever you bought it, plus renovations, that's the cost. SARS does not use the latest. You will never do that. Right. So this plus this will be the value for SARS. 1,235 plus 542. All right, so if you say 1,235 plus 542, how much you get? From your taxation, you know this. Whenever a building is improved, you claim the allowance. Né? But although this is commercial, or residential, it's not new and used. This is section what? Section 30, what? Residential properties, okay? Right, that plus that, how much you get?
Mm. 1,727,000.
So you got how much? Your 1,777 peso. All right. So remember, this one, SARS does not give an allowance. They did not say. SARS is saying we only give 5% to the what? To the manufacturing plant. That means the building. But on residential, nothing. So therefore, SARS will recover the gain through what? Capital gains, tax, and the rate of 28%. Right. Remember, you guys in your accounting, you don't depreciate the building under residential. As we say, it does not depreciate. It only appreciates. Okay. But the buildings under PPE depreciate. Hope that's clear. So it's all about classification. If the building is held for capital appreciation purposes or for rental purposes, that's an investment property. Therefore, that building does not depreciate. But if the building is owner occupied, we are using it, it depreciates. There is no 80%. Right. Whatever you get is your answer. The carrying amount of an asset is greater than the tax base, so it's going to be. And then the overall amount will be your deferred tax liability. Okay. That is your total. How many marks? How many marks? How many marks? 14. Right, so that's how you treat an integrated question. So when something is integrated, it doesn't mean that like the information is mixed. No, you are able to pick PPE, you are able to pick investment property, you are able to pick up revenue, you are able to pick up deferred tax. I think mostly when it comes to these ones, the integration is on that profit before tax note. That anything that affected the profit before tax, right, from revenue, right? If there is any revenue that needs to be recognized, you put it under income. All right. If there's anything from PPE, which is depreciation, you put it under what? Expenses. If from the investment property there is any rental income, that's where the integration comes into play. But topics are always separate. Just that they are put in the question, but you are able to, based on the information that I've been explaining, and you pushing yourself and sleeping less,